Good afternoon, ladies and gentlemen, and welcome to the Discovery Group PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Discovery Group PLC. Nick, good afternoon, sir.
Hello, Jake. Thanks very much. Hi, everybody. Thanks for joining this afternoon. My name is Nick Jeffers, and I'm joined here with Simon Gibbins, our Group Finance Director.
Hi, guys.
So we're going to take you through just a quick couple of slides, highlights on the results for 6 months to September, our first half FY26, and then we'll go over to Q&A. So, the first thing to say is that we have achieved a record level of profitability in the first half. Operating profits are up, earnings per share are up, and we'll go into a little bit more detail, of that. But, we've been through a very globally, the world has been through a very tricky cycle since COVID, culminating in a down cycle over the last 12 or 18 months. But through that period of both up and down cycle, we've delivered progressive improvement in operating profits, earnings per share, and operating margin. And so we're very pleased by that. That's no sort of small effort to achieve that, and it demonstrates the resilience of the business model through the cycle. That is, that it can grow strongly in good times and be resilient in weaker times. In addition to that, we returned to organic growth in the second quarter. Organic sales were up 1%, and organic orders were up 8%. In fact, we have 4 operating units in the business. Now we have 3 of those 4 back into good levels of organic growth, upper mid-single-digit organic growth across the 3 of them. And we're just in the final stages of waiting for the 4th division, the controls division, to recover. So during the first half, that figure was still down quite a bit, actually, but it's coming out, we think, in the second half. So all of that netted out with an operating profit up 5% and operating margin up 30 basis points to 14%. Again, it's a record margin level for us and puts us on, in good shape to move towards our 17% operating margin target. Adjusted earnings per share up 6%. That's we're benefiting a little bit there from the reducing interest rates, and then which obviously it looks like it's set to continue to have fully floating finance rates. So as interest rates come down, we'll continue to benefit from that. Yeah. And perhaps the greatest metric of all has been and is always with us is our cash flow. Our free cash flow continues to be converting at over 100%. And actually our average over the last 10 years is over 100%. So very, very strong cash flow, which we're absolutely delighted with. We, as those of you who are familiar with the business will know, we redeploy that cash flow principally into acquisitions. We have a very strong pipeline of acquisitions underway. Indeed, with these results announced on Tuesday, we announced the acquisition of a small bolt-on called Keymat that was signed on Monday of this week for 5.5 million sterling. And actually, yesterday, we announced a second acquisition, a business called Trival, an antenna business, military antenna business based in Slovenia, which we've acquired for 40 million sterling. And there's more in the pipe behind that. So overall, these results put us on track to deliver full year adjusted earnings per share in line with our expectations. We're well set for growth. Our first half, second half profit and earnings per share weighting is 48-52. So we're not expecting a great hockey stick in earnings in second half. It's certainly from our perspective, a very sort of realistic second half expectation in line with our historic trend in first half, second half balance. So that is a highlight of the figures overall. I'll maybe pause there and hand back to Jake.
Perfect, guys. That's great. And thank you very much indeed. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, you can see there we have received a number of questions, and thank you to all of those on the call for taking the time to submit their questions. But at this stage, guys, if I may just hand back to you to respond to those questions where appropriate to do so, and if I pick up from you at the end, that'd be great. Thank you.
Thank you, Jake. We do have a question come through. Can you talk about the strategic fit and expected synergy from the KeyMat acquisition, particularly alongside the cursor controls in the magnetics and controls division?
Yeah, so KeyMat is a bolt-on acquisition into Cursor Controls. Cursor Controls is a business we bought about 8 years ago, based in Newark, a super business in the HMI, human machine interface space. That's basically sort of trackballs with integrated keypads and custom keyboards. And so KeyMat is a sort of very much aligned with that. They make these custom keypad interface units, particularly for the visually impaired. So the business will continue to operate under the existing management. The main shareholder, it's a retirement sale, and the main shareholder recruited a management to run the business a couple of years ago, and that management continues to run the business now, and will do for at least the next 3 years. So the business will operate to its pre-agreed business plan, very much as it did before, but reporting into the Cursor business as part of a cluster, as we do with many of our businesses.
Thank you. Next question. M&C saw organic revenue declines while S&C delivered 7% organic growth and strong margin expansion. Can you elaborate on the structural differences in end markets or product mix driving this divergence?
Yeah, so M&C is magnetics and controls division, and S&C is sensing and connectivity. So we have 4 operating units: magnetics, control, sensing, and connectivity. In M&C, magnetics grew along with the sensing and connectivity division. Controls is the one, as I mentioned earlier, the one of the 4 that didn't grow. And there's no structural difference, actually. The cause of the decline in controls was 6 large customers, all US based, that had some fairly extensive overstocking. So they came late to the overstocking situation, but then when they realized, they obviously have to address it. So during the half-year period, those 6 customers dragged down the overall controls division. Actually, and so within M&C, that's the drag effect. Actually, the magnetics division grew in good single-digit levels, so that's going fine. And in fact, aside from the 6 customers in controls, the rest of controls grew actually quite well as well. So it was just a little bit unfortunate that there were 6 customers that had all had this overstock situation to deal with, and it just takes a little bit of time to burn off. In the normal course of business, we always have 1 or 2 of the customers with such situations. It's just a little bit unusual that we had 6 at one time, but it's kind of harks back to the post-COVID sort of boom, supply chain shortage, and then correction period, and it's just the final unwinding of that. So it's sort of slightly irritating at some level that it dragged the numbers down, but it's not a structural difference. It is just it's individual customer specific issues which will flow through, and then in fact we expect to start seeing it improve through the second half.
It's worth actually noting that the actual operating margins in controls are actually higher than some of the other 3 operating units, which sort of reinforces what a good performance it was. So we've actually managed to raise in all of those 4 operating units, and raise average gross margins by around about 1 percentage point, which is very good. So even though the higher margin unit is down, we've managed, as you've seen, to grow operating profits and operating margin during that period, which obviously bodes well as growth comes back into controls.
Thank you. Can you give more background on the two acquisitions that you did, you announced this week, Keymat and Trival Antenna?
Yeah, so Keymat we've talked about a little bit already. It's going to sit within the Cursor cluster. They make human-machine interface products. Principal line of their business is products for the visually impaired, for sort of keypads on sort of public use booths and the like, passport verification, for example, and McDonald's ordering terminals. That business has been growing its sales into the UK and US. Since the European Union has recently adopted similar legislation, we expect similar growth opportunities to present themselves in the EU. So it's a good, high-quality business. It's been around for a long while. It's had a few very good years recently on the back of this visually impaired, this keypad for the visually impaired. That opportunity still has some way to run, and we will be investing in the business and supporting the management there to continue that growth. So great little business, absolutely top dead center in terms of a Discovery bolt-on type acquisition. And then Trival that we announced yesterday is a designer and manufacturer of antennas for military, principally for defense applications. It's based in Slovenia, Ljubljana, and they supply NATO-friendly countries with antennas. So their principal countries are Europe, US, and the such like. Again, sort of small business, very high quality product. Obviously, defence is an area of growing sort of spend and opportunity for this business, and so we bought this business to invest in growth over the sort of short, medium, and long term. So the largest sort of territories are Europe and the US, but the absolute sales that they have in those territories is actually very small. So we feel that by sort of investing in the business, we can grow the opportunities as we've done it. There are some characteristics of this business that are very similar to a business we bought back in the early days, which has gone on to grow very strongly, consistently strongly for a good deal of time. And that is that they make a very niche product that they sell into very large customers, but their size as a supplier into the customer is very, very small. They just focus on super niche products, which have a very high opportunity for margin, good margin. And what we found with one of our other businesses is that by just investing in the sales channel to look for more of those sort of niche, micro niche opportunities in these big customers, you can build a really strong position. And we think that Trival is going to do the same. And that kind of builds on their fundamental organic growth opportunity, which is, particularly in Europe, there are a lot of countries, particularly sort of Nordic region, some of the Eastern European countries that are investing in their military capabilities. And the markets that Trival supply into are principally antennas for things like radio, manpacks, the combat soldiers, manpack radio communication, and antenna masts for in-field use. So an area that is already receiving more attention and spend, and we think will continue to grow.
Also it will sit, that business will sit alongside our existing cluster of, we've got two other antenna businesses, 2J and Antenova, so it'll sit alongside that. They don't as yet sell into military, but the products are very compatible. So, it gives us a really nice opportunity to develop their sales channels, working alongside Trival. So, we're hoping we'll get some good top line synergies from that.
Thank you. Are you comfortable with the ability to source rare earths on an ongoing basis?
Rare earth materials, yeah. Rare earth magnets, yeah. So yes, we have looked into this, as you might expect, in some detail, and we are able to resource the materials we need. At the moment, we don't actually need to do the resourcing because we are getting the supply. Products are now subject to export license from China. The one that we source is subject to export supply from China, and that is happening. So we're receiving the products, but we do have contingency plans should we need them.
Thank you. With regards to your acquisition pipeline, have changing market conditions change your pricing expectations or shifted your focus towards your particular end markets?
So we have seen over the last year or two that the frothy pricing expectations have tempered. I mean, two things have happened. 2 years ago, businesses were attempting to be sold on the basis of forward earnings growth and at a higher multiple. So you get a higher multiple on a higher predicted or higher expected profit figure. Whereas now that businesses are being valued on current or last 12 months valuations profitability, and the multiple has typically come back a turn or two. So the combination of those two things having changed, it makes quite a material difference to the value being paid. So they have tempered, and that's why we are buying particularly at the moment, and it's a good time to be buying from that perspective. In terms of focus, I mean, what we are doing more of is both organically and acquisitively. We're investing and focusing on the defence markets. We do quite a lot in particularly passive defence. So we have, with this acquisition, obviously established a position. We've got more acquisition opportunities that are facing into the defence markets, and also organically we're developing both our opportunity pipeline within our existing businesses in the defence space, and we're also investing in sales development resource for the defence market. So the defence market will become a growing part. It's a small part at the moment, and it's never going to become defence only business. It will always become one of our 5 target markets. So the reason we have 5 target markets and a relatively low or a very low customer concentration is because we want to achieve consistent growth in earnings and profits through the cycle. So in order to do that, we want to have 5 target markets which will create revenue growth of varying degrees through the cycle, and then augment that with acquisitions. And so that to try and create a blended growth in earnings that is delivered consistently. And if you look back at our 10-15-year record of earnings and profitability growth, that's exactly what you see. Our increasing focus on the defence market is just a sort of one step in building that capability.
Thank you. There seems to be no more questions. I'm going to hand the floor back to you, Jake.
Perfect, guys. That's great. And thank you very much indeed for addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Nick, perhaps before really now just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, so thank you for the time today. I mean, the business has delivered a strong set of results through a tricky old period. We're very confident in the ability of this business to deliver sort of sustainable performance, and the business is in good shape. We're well set and coming through into the recovery phase of the cycle. Obviously, that will be modulated to the degree of economic activity, but as you've seen through the last couple of years, the business is, it so far has always performed ahead of the market overall, both with focus and by not focusing on weaker markets. So we feel that we're in good shape to do that. All our growth drivers, both organic and acquisitive, are in that shape, in good shape. And so we keep going and look forward to sort of having another good performance next year.
Perfect, Nick. That's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Discovery Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.